Good morning, friends. This is Balasubramanian Iyer welcoming you on 10th of October 2017. It's about 20 minutes past 10. There is a very important subject that I want to address, and that is the mental accounting. Now, Richard Thaler was awarded the Nobel Prize for economics a few days ago. You can say he's the guru or the godfather of behavioral finance. And I'm very glad that behavioral finance or behavioral economics has been given its due recognition and it's now becoming mainstream. Now, this whole concept of mental accounting, mental heuristics, prospect theory, anchoring bias, and all that, these are so important in all walks of life. But this video, I'm going to give you some examples how in trading, whether you are a day trader, swing trader, investment, whatever, the application of mental accounting, mental accounts is so important, and why we do what we do, all the mistakes. So let me give an example. What the Nobel, and I think Kaufman or someone has also got the Nobel Prize a few years ago, and he has some great ideas. In future videos, I will go into detail on the subject. So trade. Let me give an example. As I was saying, so let's say you put a trade on a market, say S&P 500. You went long, and the trade was in your favor, say $1,000 profit. Okay. Now what you did is you moved your stop loss to break even plus a few ticks, so you cover the commissions. Okay. So the trade, and now let's say, and you did not cash the profit for whatever reason, then suddenly the market reverses and it stops you out. Now, let's say this is an exam question on behavioral finance. Okay. You ask 99.99% of the traders will ask them the question, what happened on this trade? Did you lose money or did you make money? And I can tell you all of them will fail in this exam. So let me pause and ask you the question. You took a trade was in your favor, more than $1,000. You moved the stop, break even plus a few ticks, so you covered your commission. Okay. So and then you got stopped out because you didn't cash the profit. Market reverse. Did you make money or lose money? So most traders will say that no, I didn't lose money. I never. I recovered. In fact, I even recovered my commission. Now, according to the Nobel Prize winners, and that's why they got the Nobel Prize, the answer is wrong. You did lose money. And this is coming from this concept of mental accounts. What we think is the money, like when you are in profit, here is the concept. When you are in profit, $1,000, you have these in buckets. Like the money that you invested to put the trade is your money. That $1,000 profit you made is free money or market money. You are not, as the money is fungible, that is also your money, whereas you're taking the view that that is not my money, that is market money. Okay, that's where you're wrong. Okay, and that's what the Nobel Prize is all about. So what these scientists are saying is that you worked hard, you did the analysis, you spent 3 hours managing the trade, so that profit of $1,000 which you lost is actually a real loss. In fact, there have been a case where a couple had a divorce, and I'll give you the details of the divorce. Where she sued, she filed the divorce on this case, and I'll go into more details what happened. And this was a classic application of mental accounting, and the case went to the court in I think it happened in India. Now, let me give another example of what Taylor's work of the great genius they have done. This is called the prospect theory. So prospect theory, what happens is when you are in, and this explains why we as traders, we hold on to our losses, but we come out of the profit with small profit. Why do we do that? It's because of the way our brain is wired, and you need to, this mental accounting is a disease. Okay. And each one of us have this disease and you have to fight it. That's what the Nobel Prize winners are saying. So what these scientists are saying, for example, in the prospect theory, you put a trade, you are in say $500 profit, and the trade has a potential to make $5,000 profit. Okay, so now you have two outcomes. Either you make a large gain, which is $5,000, or you make a small gain, which is $500. Or what if the trade reverses and hits the your, and let's say you move the stop to break even, okay? So and then the market moves and hits a breaker, then you make no gain. So there are two outcomes. So I'm giving you prospect theory in trading. One outcome, you make $5,000. Second outcome, either you make the $500 or you make zero. Which one will you choose? So what they found out that most human beings, almost 100%, will go for the second option. They'll give up on the $5,000 profit, and because they are so fearful, paranoid of landing up with no gain, they will book the $500 profit and will be relieved. That's a big blunder, a big mistake, according to prospect theory. Now, in other words, when you're managing profits or gains, you're becoming averse. Risk averse. This is shocking. Now, take the other case when you're in a loss. So let's say you are in a trade and your loss is $250. Now you have one outcome. You can book your $250 loss and come out. Outcome number two, if you stay in the trade, there is a chance that that $250 loss can become $2,000 or it can be zero. Price may come back to your entry and you may be able to come out of the trade with zero. So again, repeat, two outcome. One outcome, book your loss as 250, get out. Outcome number two, loss could become 2000 or loss can become zero. And guess what? Most traders, according to scientific research, they took the second option. They did not book the $250 loss because that loss aversion, the pain, they wanted to, that zero. Remember in outcome two, I gave you two choices. Either you lose 2000 or you lose zero. That zero attracted them. So when it comes to pain management or loss aversion, they actually become aggressive and take more risk. So when managing profit, when you should be more risk taking, they become risk averse. When managing losses, when you should have risk aversion, almost 99% of human beings become risk takers. They become aggressive in risk. That's why traders hold on to their losing positions and keep losing money. And see, you saw the outcome. This is called prospect theory, which is why Thaler got the Nobel Prize for this. And the Nobel Prize committee recognized that this is a universal problem. Worldwide, human beings are facing this. And you have to recognize that this is a disease. This is a disease. You have to solve this problem. If you don't overcome it, you are not going to be successful in trading. Please try to understand that. The prospect theory and the mental accounts, I gave some very nice examples, some food for thought, how you should handle it. Now, there is other subject called mental heuristics, which is also the subject of some previous Nobel Prizes. And Thaler has also done some work on it. Okay. There is sunk cost fallacy. I'll go into all that. This is very interesting. It's called anchoring bias. So let's say you put a trade and you bought S&P at a certain price, say you bought S&P as 2500. Now S&P has gone down or gone up away from that price. Instead of objectively evaluating the position in the market where the market currently is, you what you do is mentally you anchoring bias. You anchor yourself to your purchase price, that the price at which you bought S&P. So the market doesn't care where you bought it, okay? But because of this anchoring bias, as you hold on to your trade, wait for the trade, assuming you're in a loss to come to the 2500, and then you try to come out, and eventually you lose money, and that's because of the anchoring problem. The another anchoring problem is you enter at a 2500 price at the top of the market. Because you entered at 2500, you are expecting the market to go up another 10 points. And that again, why would the market do that? The market has already gone up 30 points before you took the trade. But because of this anchoring bias, it's a disease. You are expecting market to give you profit and move up from 2500. This is again part of mental heuristics. It's a very fascinating subject. I'll sign off now and I'll go into more details with more examples. And this whole subject of behavioral finance and mental accounting applies to even day to day life. When you buy a car, when you buy a home, how you get trapped by this disease. Okay, we'll address it in later video, but this is a very important subject, very, very, very important for traders. Okay, don't ignore it. God bless you. Bye for now.